Good morning. Good morning. This is Jeff Christian from CPM Group in New York. We're going to be releasing our Platinum Group Metals Yearbook for 2021 now, as of right now. And so this presentation is a briefing that will cover the contents and conclusions of that report. I'll speak a little bit initially about prices and inventories of metals, as well as the economic environment, if I remember to talk about that. And then I'll pass the screen to Rohit Savant, who is our Vice President for Precious Metals Research and the primary author of the PGM yearbooks, as well as the gold and silver yearbooks and other precious metals research. He'll run through the specifics. I'll pick up those esoteric metals of ruthenium and iridium at the end, and we'll open it up for questions and answers. So let's get started. The cover today, we used the May 1981 J. Aaron Platinum and Palladium Review and Outlook. That was our first published report on these metals, and in May of 1981, it was probably the first market report dedicated to Platinum Group metals. At the time, the South African producers did not even release data on how much metal they produced, let alone costs or inventories or anything else. It were all corporate secrets. And the other major supplier was the Soviet government, which had sanctions on it because it had attacked Afghanistan in December of 1979. So it was a very secretive market. Fabrication demand is always secretive across markets because there's no economic incentive, there are economic disincentives, and there are no regulatory issues that would cause fabricators, let alone secondary refiners of metal, to disclose their information. So we produced this report in May of 1981. And we took data back to 1976, which is why most of the data that you find on PGMs goes back to 1976. I had begun doing research on PGM markets in 1979, and then we published this report. We published reports every 12 to 18 months when we were J. Aaron Goldman Sachs. In 1986, we left Goldman Sachs and set up a CPM Group to be an independent commodities research and consulting company. We've continued to publish these reports for the first decade of our existence at CPM. We were doing quarterly reports. We pivoted to annual reports in 2001, after 9/11 actually, and we published these reports ever since. So we've got 39 years of annual surveys under our belt. The other report on the right-hand side of the screen, obviously, is this year's report. And that's what we're here to talk about, with a few jewelry pieces in between just to lighten it up. We always have to thank our sponsors. These are companies that provide us extra revenue, which helps to support the research program that provides the data on PGMs. And those of you who know us know that we're very independent. We are paid to be right, not to be bullish or bearish. We're not marketing people or arms of marketing groups. And so these are folks who say, no, we really want to know what's going on. Grid Metals Corporation, Group 10 Metals. These are Canadian exploration companies that have interesting properties that may move into production at some point over the next few years. They're mining companies that investors can invest in. Kitco, obviously, is a precious metals refiner, as well as purveyor of information and price data. Noah Capital Markets is an institutional investor broker in South Africa. Umicore is one of the largest refiners and suppliers of Platinum Group metals, as well as a host of other metals in metal form and in semi-fabricated form. Institute of Scrap Recycling Industries obviously represents the scrap recycling industry in the United States. Sabin Metals Group is another refiner of Platinum Group metals and a provider of refining services as well as metals. And Monex is one of the largest precious metals retail outlets in the United States. We have a group of Chinese partners that have translated and distributed our gold and platinum yearbooks in China for many years now. China Gold Association, which is the industry association in China, China National Gold Corp, which is the state-owned largest gold mining company in China, and Beijing Yicheng Technology, which is a new company to us as a sponsor of this report. And they provide all of the infrastructure that's involved in translating this report into Chinese, distributing it within the Chinese market. Our contract with them specifies that they do this with us because they want to provide accurate supply, demand, and price analysis, data and analysis to the Chinese jewelry industry as well as other fabricators of PGMs. And then we have media partners and distributors. These are Kitco again, Metals Daily, and as a distributor, Introact, which is a provider of market research to institutional investors on a global basis. And they distribute the reports and information more broadly. Again, I'll talk about prices and inventories, but let me speak a little bit about the economic environment right now. I don't have any charts on it, but this morning the US Consumer Price Index came out and it was relatively high. Headline inflation was high. If you looked at the core inflation, which takes out food and energy, you saw still high inflation of about 4.5% annualized rate, but down from about 5.9 for the headline data. If you look at the components of inflation, oil prices and oil product prices were up 45%. Used car sales prices were up 45%. If you take those two out, you see a core inflation that is much lower than the 5.9 or even the 4.5. So what you're seeing are a couple sectors affecting that. And that's exactly what the Treasury and the Fed and other mainstream economists have said, that we're seeing transitory inflationary pressures as the world comes out of the lockdown and as the supply chains are rebuilt, having been disrupted. There are some other inflationary pressures like US sanctions and trade restrictions and tariffs, which are adding to inflation. But the bulk of the increase that we've seen in inflation has been much more a matter of these transitory factors. If you don't believe me, look at lumber prices. 3 months ago, 6 months ago, no, not 6 months ago, but 3 months ago, 4 months ago, the world and the internet commentary was just completely overrun with the fact that lumber prices had skyrocketed. And this was a permanent thing that was going to destroy the housing industry and was going to cause hyperinflation in the United States, et cetera, et cetera. So please buy gold. Lumber prices today are down 0.6% from where they started the year. That temporary disruption in the supply of lumber is over. And what looked like a permanent hyperinflationary problem that was going to destroy the housing industry in the United States and Canada is gone. So when you look at the 45% increase in oil prices this past month and the 45% increase in used car sales, you have to take in mind the fact that these may in fact be temporary factors. Do you think that the oil price is going to rise another 45% next month? Probably not. So we're not concerned about hyperinflation. On a long-term basis, we remain concerned about deflation. You are seeing some other things. So for example, the cost of food bought for consumption in the home rose only 0.9%, but the cost of food to be consumed in restaurants rose about 9%, like 10 times as much. Not because labor is getting more pay. In fact, the amount of money being paid to employees is down, but because the restaurants are increasing their prices 10% or more in order to try to make up for the losses they've experienced over the last 10 years. And under the guise that, oh, well, the government's forcing us to pay these people livable wages. The wages haven't shown up, but the price increases have in food consumed outside of the home. So we're not worried about hyperinflation. We do see the economy recovering. It's moving through the recovery stage. It hasn't gotten back to the expansion stage, but it will. There are any number of storm clouds on the horizon: economic, financial, political, and epidemiological. The risk that the WHO has been promoting of another wave of COVID-19 in a more resistant strain in the third quarter is real, and it's something that we are watching out for. We gave an interview yesterday in which somebody was talking about the idea that the IMF might seize all of the cash that Americans have. I said, well, first off, the IMF doesn't have the right or the capacity or the legal capacity or the physical capacity to do that. And second thing, it doesn't make any sense that it would. So that's not a highly improbable event to worry about. It's an improbable event to worry about. There are much more important things to worry about. At which point the interviewers said, well, you know, a year ago or 3 years ago, you would have said that about COVID-19 or the insurrection on the 6th of January. At which point I said no, because if you go back, epidemiologists and medical experts around the world were saying there was 100% probability of another pandemic, probably with a coronavirus. It wasn't the 19th coronavirus, as Rush Limbaugh famously misrepresented it, but they were saying there will be more. And in fact, scientists in China now are looking at another coronavirus that they've identified in wild animals. So there will be more pandemics. And people knew that 3 years ago, 5 years ago. The White House under Obama had created a special team to look at how to deal with the next pandemic after the Ebola crisis and the SARS crisis. The Trump administration disbanded it, so they were acting as if it didn't exist, but everybody else knew it would exist. Similarly, the Pentagon has been worried for years about how its military would react if there were an attempt to storm the Capitol or some other form of right-wing insurrection. And they had a little test on January 6th. But they've been worried about that, not for years, they've been worried about that for decades, as has been the FBI, the Justice Department, and other sentient human beings. So those are more probable issues to worry about that might cause you to say, I think I should have some of my money in gold and silver. But you don't have to worry about the IMF coming into your bank account and taking your money. That's just something that people who want to scare you into buying gold say. Yeah, that's a bugaboo, for want of a better word. We do see the economy continuing to expand 2021, 2022. We do see storm clouds on the horizon. The continued expansion and recovery of the global economy will benefit PGMs over the next 18 months or so. So let's talk about PGM prices and inventories. Platinum fell sharply after the strike ended in 2014 in South Africa, and it still hasn't recovered. We saw the price rise sharply to about $2,000 in the beginning of 2008. The price traded basically above $1,400 from then into 2011. There were a lot of economic problems. There were a lot of financial problems. There were a lot of political problems. The United States Treasury had screwed the world in bailing out the banks in 2008. The Chinese government said, we got to grow a spine here because the US government has shown us exactly what they will do in the next economic crisis. And they started to assert themselves more strongly. And we saw platinum prices of $1,500, $1,600, $1,800. After 2011, investors started selling. They sold 2012, 2013, into 2014. When they saw the price flatline, above $1,400 during the strike in South Africa. And the South Africa's largest producer kept saying, don't worry, there are so many ounces in inventories above ground. We can supply not only our clients, but we can supply other producers' clients during the strike. So there's no reason for investors to buy platinum during the strike and drive the price higher. And the investors said, okay, we'll take your word at it, which means that when the strike ends, this price is going south. So you didn't see investors buy during the strike. And in fact, they sold, and that kept the price down. And then when the strike ended, the price went from above $1,400 to $800 over the next 18 months. And the price traded between 800 and 1,000 for most of the period from 2015 through 2020, actually. And we had a big spike down when we shut down. And in the final month of 2020, and really in the first 2 months of this year, you saw the platinum price finally break above $1,000 in a meaningful and sustained fashion. And the price went up over $1,200, almost to $1,300. I may have actually gotten to $1,300. It's come off and it's trading about $1,112 today. But we have now seen the platinum price move upward. And that's something that CPM Group has been saying we thought would happen for several years. We thought that the platinum price would come out of this long period of low prices and start rising at some point, because for a variety of reasons, which Rohit will be much more eloquent in talking about. But basically, platinum's being used in auto catalysts. Yeah, electric vehicles are a long-term threat. They're not a short-term threat. You know, electric vehicles are about 4% of the market last year, but the market was off something like 20%, 2019 to 2020, the auto market. There's a period of time for the next several years where the auto industry is going to be fully dependent on PGMs. And there's going to be a shift, there is a shift underway away from palladium toward platinum. And all of that benefits platinum and helps push the price up. And even if you take the most optimistic market penetration rates for EVs, you're still talking about 2/3 of the cars in the world probably using gasoline or diesel 10 years from now. So PGMs are still going to be integral in the auto emission catalyst process. And that's positive for platinum. So our expectation is platinum price consolidates above 1,000 and moves higher over the course of the next 18 months and beyond. Get back here. There is a lot of platinum around. And when we started publishing this data, we've had this data since, you can see, 1978, 79, when I started collecting it. And we made an estimate that there was about 4 million plus ounces of platinum in above ground refined inventories in 1976. And that was an estimate we made in 1979, 1980, 81, as we were developing the initial estimates of supply demand. And we were able to take our supply demand data back to 76. And then we had data going back to 1900 for some segments of supply and demand, but not all segments. So we made a view that there was about more than 4 million ounces of platinum in inventories, and that a lot of that actually was in the Soviet government's inventories. And we had some special insights because we worked for a company that was the major buyer of PGMs from the Soviet government at the time. And we had other insights too. You can see from that red line, you've seen a steady increase in above ground refined inventories. The ownership has changed dramatically. We started breaking it down for the public consumption as to where we thought that was. The biggest portion is unreported but estimated inventory holdings. And we estimate those based on information that we get from our clients and from the broader market, as well as trade flow studies. Trade flow studies are notoriously inaccurate, and for many decades, people would go to great lengths to obfuscate their imports and exports of PGMs and other commodities, and they still do. But the trade flow studies give you some information, but really it's market research and analysis and intelligence that gives you these other numbers. When we came out with these numbers in 2013, there was a lot of disbelief that the metal was so high. In fact, marketing people who really hadn't organized themselves yet said, oh, it's probably half as much, and everything but the unreported inventories doesn't really matter because it will never come back to the market, which wasn't true, but that's beside the point. We saw those inventories being sold by investors in 2012, 2013, early 2014. They pulled back from that once the price fell below 1,400. And some of those investors are still holding on to the metal, saying, when the price starts rising again, we'll evaluate if we should resume sales, at what price we should resume sales, or if we should resume buying. And it's all going to depend on why the price is rising and our analysis as to how high it's going to rise or where it's going to stop rising. So that's on the horizon. And there's a lot of platinum out there that is held by investors who are studying the market and trying to decipher good data and good analysis from marketing hype. Palladium has been the opposite. You saw the palladium price really flatline from 2011 into about 2017. This kind of doesn't really do it credit because it went from 550 to 750 and back down to 500 and then back up to 750 and then up to about 850 and then back down. And we actually had clients that we were advising on buying and selling palladium who did extremely well trading that range. And a $300 range is extremely large range over that 5-year period. But then it got really interesting. The price started rising on a persistent basis in 2016, and it continued, and then it accelerated after 2018. And it's risen very high to record levels. Our expectation is that palladium prices don't come back down that far. We do see the palladium price not continuing to rise as rapidly as it has over the last 2 or 3 years, but we don't necessarily see it falling. And the reason is that the palladium market actually is really tight. And palladium, like platinum, remains extremely critical to the auto industry, as well as the semiconductor and electronic industry, and a host of chemical and petroleum refining catalyst applications, and a lot of other industries. So palladium is still a very important metal, and it's going to probably stay high price-wise, although it may not rise further, or it may not rise further for the next 18 months, but it could rise further in the longer term basis. There's a lot of palladium out there. There's a lot of palladium that's out there in investor hands. Those investors have made the decision to not sell their winners and keep their losers. So palladium prices have risen, and they've been very happy with the fact that they're long physical palladium. They haven't necessarily been sellers over the last couple of years. They're a little bit nervous because the price is so high by historic standards, and it has been kind of moving sideways at historically high levels. But so far, they haven't really sold. And until they decide that maybe the palladium price is going to fall, that palladium remains at rest and is unlikely to have a negative effect on the market. And it's interesting that, and Rohit will talk about this a little bit later, most of this palladium is not held in ETF forms. This is held by large institutional investors, family offices, and very wealthy people who are holding it off the market in their own holdings, as opposed to through ETFs, the way you see it in other people. My last chart before I kick it over to Rohit is on rhodium prices. And rhodium prices have gone parabolic. They've come down with a thud, but let's be honest, they're higher than they were at any point prior to the middle of last year or late last year at current prices. And we've talked about this annually for several years, the idea that the rhodium market doesn't have the above ground inventories that you see in platinum palladium. And I won't show you a chart of our estimates of rhodium above ground inventories, but our estimates suggest to us that the rhodium market is extremely tight. It's getting less tight, and Rohit will talk about that when he talks about rhodium. There is some relief, and you can see that with the price coming off from $30,000 down to about $15,000 at present. But the reality is that rhodium is indispensable for the auto industry. It's probably going to continue to be indispensable for the foreseeable future. And there's not a lot of inventories around in refined rhodium above ground to meet those future demands. So I'm going to kick it over now to Rohit, and I'm going to let him talk about platinum, palladium, rhodium. I'll see you on the other side, and I'll talk a little bit about iridium and ruthenium, and then we'll open it up for questions. Rohit?
Thank you, Jeff. Before I start, I should just warn you that they seem to be testing the fire alarms. So there's likely to be a lot of disturbance while I'm making the presentation. So I apologize for that. So let's start here by talking about total platinum supply. This is the supply which is made up of mine production as well as scrap supply. And this total supply declined to about 6.4 million ounces in 2020, which is its lowest level since 2014. Now, while both sources of supply declined in 2020 primarily because of COVID-related disruptions, both of them have been in a declining trend for a few years now. So mine supply has actually been in a declining trend since 2006, primarily weakness in South African mine supply, but also from a lot of other major mining regions. You've been seeing a decline in platinum supply there, with the exception of Zimbabwe. Scrap supply, meanwhile, has been in a declining trend since 2015. And the main reason for weakness in scrap supply has been weaker platinum prices up until late 2019, and also just reduced amount of platinum loadings in the auto catalysts that are being recovered at this time. So both these factors have been weighing on scrap supply, which we think would be a headwind even in coming years. So South African platinum mine production stood at 3.7 million ounces in 2020, which was down about 16% from 2019 levels. Most of the weakness that we saw out of South Africa last year was related to COVID-related disruptions. You had mine closures, then the mines were reopened. They were only partially reopened for a period of time. And then the ramp-up period was also particularly slow in the case of South Africa because of the deep-level mining that we see in that country. In addition to the COVID-related disruptions, you had technical issues at Anglo Platinum's converter plant, which further weighed on platinum refined supply during 2020. Zimbabwean platinum mine supply was flat during the year. Mine production there was not really affected much by COVID. You had about 485,000 ounces of platinum being produced in Zimbabwe. Platinum scrap supply slipped in 2020 to about 1 million ounces, which was its lowest level since 2001. Again, there were multiple reasons that resulted in this weakness. One was the reduced scrappage of old cars due to the recession. There were supply chain disruptions due to COVID, and generally lower platinum loadings in auto catalysts. In 2021, we expect total platinum supply to increase, but we still think that it would be lower than levels that we saw in 2019. We forecast total platinum supply to be about 6.8 million ounces, which is roughly about 7% higher than what it was in 2020. So we think that total platinum supply will be adversely affected by the lost mine production in Russia from the suspension of Norilsk 2 mines earlier this year. And while we expect scrap supply to increase in 2021, we do see some of those headwinds, especially related to lower platinum in auto catalysts that are being recovered continuing to be a headwind. So we think both these factors together will sort of act as a headwind to total platinum supply in 2021. So the next couple of slides deal specifically or are focused more on South African platinum supply. More recently, what you've been seeing is in South Africa an increased focus on the UG2 ore body and to a certain extent the Platreef ore body versus Merensky. Now this has important implications for platinum supply in the long term. There's been this shift away from Merensky towards these other two ore bodies for a couple of reasons. One is the Merensky ore body has been heavily mined over the past several years, decades, and that was because of its low chrome content. But also what you've been seeing in recent years is a sharp increase in the basket price of the UG2 ore body. So the UG2 ore body is richer in Palladium and Rhodium than is the Merensky ore body. So there's an economic incentive there for mining companies to also focus on this particular ore body. And this particular ore body has relatively lower amounts of platinum than the Merensky ore body had. So we do think that this trend will continue, in part because of the stronger metal prices for Palladium and Rhodium, but also just because there isn't that much of the Merensky ore body remaining. The Merensky ore body today accounts for, or rather at the end of 2020, accounted for only 14% of total South African reserves. So there's just been essentially been a depletion of that ore body. This chart shows South African capital expenditure on the platinum mining industry. A decline for the second consecutive year during 2020. Part of that had to do with COVID, but most of it really had to do with a reduction in capital expenditure by Northam after its Booysendal mine was fully ramped up, and by Sabin, which has been spending more outside of South Africa on its mines outside of South Africa. Going forward, mining capex for the PGM sector in South Africa is likely to soften from its present levels. And this, again, like the shift away from Merensky, is likely to have a adverse effect on platinum mine supply in particular because of the concentration of platinum and rhodium output out of South Africa. So both of these factors, we think, will have negative consequences for longer-term platinum mine supply, which we think would be positive for the price of the metal in the medium to long term. So with that, we move on to platinum fabrication demand, which was down about 13% last year. It was down to about 6 million ounces. Primarily driven by weakness in the auto and jewelry sectors, which account for roughly 80% of total platinum fabrication demand. Now, platinum jewelry demand was hurt last year because of recessionary conditions, which typically hurt discretionary purchases like jewelry. And then you also had, even though economic conditions started to improve slowly in the second half of the year, you had reduced weddings and reduced socializing, which further reduced or weighed on demand for jewelry items. This year, we expect both these conditions to reverse, which we think would be supportive of platinum jewelry demand during the current year. Auto demand, which is the largest use of platinum, was hurt last year primarily because of weakness in the commercial vehicle market. Except for China, you pretty much had declines across major commercial vehicle markets during 2020. And there also was an ongoing decline in diesel passenger vehicles in Europe as well as India, which further weighed on platinum demand from the auto sector. So platinum demand from the auto sector last year stood at about 2.9 million ounces, which was down 15% from 2019 levels. This year, we forecast that it rises to about 3.2 million ounces, which would be 13% above 2020 levels, but still lower than levels that we saw in 2019. We expect demand to benefit, auto demand, or platinum demand from the auto sector to benefit from a recovery in commercial vehicle sales this year, tighter emission standards, and also this gradual shift that you're seeing in the use of platinum, the reintroduction of platinum into gasoline auto catalysts. But that said, platinum demand from the auto sector also has or faces certain headwinds with an ongoing decline of diesel passenger vehicles and also the halting of production at various facilities because of the shortage of chips that we're seeing. So we think these two factors would kind of weigh on platinum fabrication demand from the auto sector during 2020. Now, while the two largest sectors, that's jewelry and auto, saw sharp declines in demand during 2020, some of the smaller users of platinum actually saw increases and others saw less dramatic declines. So, for example, the glass industry actually saw an increase in demand from, rather platinum demand saw an increase from the glass industry in 2020, and also declines that we saw in the petrochemical industry were fairly marginal. Now, platinum demand from glass benefited for two reasons. One, there was an increase in manufacturing capacity over the course of the year, and secondly, the deep discount of platinum prices relative to rhodium is working well for platinum in this industry because there is a certain amount of substitution between the two metals that's possible. It's usually driven by price. And so just given the discount that platinum is at compared to rhodium, it's actually benefited platinum fabrication demand from this particular industry. And we expect this trend to sort of continue in the short to medium term. So these next few slides review recent developments in the auto sector. I kind of spoke about them a little bit in my previous slide. These are just more visuals to those points. So as you can see in what you're looking at here is basically commercial vehicle sales during 2020, and you had largely double-digit declines in most major commercial vehicle markets during 2020, with the exception of China. Now, so far this year, the commercial vehicle market's been doing really well. Part of it has to do with the general economic recovery. Part of it has to do with the base effect because you're still comparing with one of the worst hit parts of last year. But nonetheless, we do think that commercial vehicle demand will continue, to rise in the present year, which we think would be a important supportive factor for platinum fabrication demand. So this chart talks or shows the declining market share of diesel passenger vehicles. The two largest have been India and Europe, and in both countries, in India and in Europe, you are seeing a pretty substantial decline in market share, and we think that this decline will continue over the next several years, which we think is something that would act as a headwind to platinum fab demand. Now, despite the increase that we've seen in platinum prices since late 2019, platinum is still trading at a record discount or near record discounts to palladium. So this keeps it attractive as a substitute for palladium. We think that this would be something that would be positive for platinum in the medium to long term. And it also makes it a compelling investment for investors. So with that, let's move on to electric vehicles, we saw a pretty sharp jump in alternate auto technologies during 2020. What you're looking at here is battery electric vehicles and hybrids, and they rose strongly last year. The increase was primarily driven by government incentives, where the governments were in part trying to boost the auto industry, but in part trying to meet the green mandates that they've put out there. And so you saw a pretty substantial increase in market share for these vehicles last year. So they at the end of 2020, electric vehicles were accounting for about 4.6% of passenger vehicle market share, which is up from about 2.6% in 2019. Now, the reason for that sharp jump is in part because of a general and a pretty large decline in passenger vehicle sales, but also because there was a pretty substantial increase in the sales of these alternate technology vehicles. So we expect market share to continue to increase this year, probably gets to about 5.5% of global market share by the end of this year. These vehicles have mixed implications for PGM demand. So it depends on what kind of alternate technology you're talking about. BEVs or battery electric vehicles are obviously the most negative for PGM demand. That's because they have no internal combustion engines. They therefore do not require these catalysts. But then you have hybrid vehicles, which do have internal combustion engines, and they do use auto catalysts, and they require a fair amount of PGMs, at least on par, in some cases more than what typical internal combustion engines require. And that's because obviously they emit the greenhouse gases and the other emissions, but they also run at lower temperatures than pure internal combustion engines. And so to offset that lower temperature, sometimes you do see an increase in the amount of PGMs being loaded in these. So hybrids are not necessarily, I would say they are in fact still positive for PGM demand. And then you have fuel cell electric vehicles, which obviously use platinum in their fuel cells. But despite the positives of hybrids and fuel cells for the PGMs, the reality is that about 70% of the alternate auto propulsion technologies is battery electric vehicles, and the rest is hybrids. So the main reason for that is because the incentives that are being given out by governments are focused more on battery electric vehicles, because they are, of the variety of vehicles available, producing the least amount of emissions. And then you have fuel cells, which account for a very small percentage of the global auto market, with only about 9,600 fuel cell electric cars sold last year and about 33 fuel cell electric trucks. Fuel cells have a future, but they do have a lot of catching up to do with battery electric vehicles. They have a lot of hurdles to still cross. They need to, there needs to be economic ways to store as well as ship hydrogen. Costs need to be brought down for vehicles, as well as the ability to produce environmentally friendly hydrogen. So there's still a lot of hurdles, especially on the cost side, which need to be met before fuel cells can have any meaningful market share. And even when and if they do have a meaningful market share in the future, it's questionable how positive that would be for platinum. Today, platinum is used in those fuel cells, but there's been all throughout an ongoing effort to reduce the amount of platinum that goes into these fuel cells, and that effort's going to continue. There have been some developments where fuel cells have been put out there without the use of any platinum in them. So if these become commercially viable, the fuel cells will have absolutely no positive impact on platinum. But that's all yet to be seen. But as it stands right now, fuel cells are, there's still a lot of hurdles to be crossed before they have any kind of meaningful impact on the PGMs. So the platinum market was in a surplus of about 280,000 ounces during 2020, which can be viewed as the metal that was available to investors. So since late 2019, we've been seeing a more positive sentiment towards platinum, investor sentiment towards platinum, and I think investors have become a lot more enthusiastic about platinum because of its relative undervalued status and because of its improving fundamentals. So platinum, as it stands right now, is cheaper than gold and trades at a record discount to palladium. It's also the price of platinum is also very low compared to its own price history. So in addition to its attractive relative value, platinum's short-term as well as medium-term fundamentals have been improving, which is something that is driving investors towards the metal. So in the short term, you have an expectation of commercial vehicle demand to bounce higher, and that would be something that's positive for platinum fabrication demand. You also see the reintroduction of platinum in gasoline autocatalysts, which is something that again would be positive for platinum fabrication demand. And then there is a fairly strong likelihood that total platinum supply continues on a declining trend in the years ahead. So this could create a tight market condition, which would help to propel prices higher in the medium term. So just last year, you had ETF investors absorb about 412,000 ounces of platinum, which is around 1.5 times the total surplus that we had in 2020. Just to give an indication of the strength in platinum investment demand. You also had investors purchase roughly about 100,000 ounces of platinum in coin form, which is the highest that it's been since 1999. So now, while this demand from ETFs as well as coins was strong and it helped to push up the price of platinum, there was and has been a lot of selling by investors as well. Investors who possibly bought platinum in the last upcycle and are looking to get out of those positions. And so this acted as a bit of a headwind. So even though you did have a pretty healthy and strong investor demand from coins as well as ETFs, prices did not necessarily spike up the way you did see in rhodium, which is a smaller market, or have been seeing in palladium. And that's to a large extent because of this inventory liquidation that's been going on simultaneously, which has been acting as a bit of a headwind to prices. But we think that would eventually die down, and all of this comes together and sets platinum up for stronger prices in the medium term. So with that, we move on to palladium. Total palladium supply also declined. It declined from record levels in 2019. It stood at about 8.9 million ounces in 2020, which was about 8% lower than what it was in 2019. Because palladium mine supply is more diversified than platinum mine supply, the negative impact of South African PGM mine supply was felt less on palladium than it was in platinum. So palladium mine supply stood at about 6.7 million ounces in 2020, which was down 6.5% from 2019 levels, which compares with a nearly 12% decline in platinum mine supply during 2020. Last year, you saw palladium mine supply rise in the US and Zimbabwe, which helped to offset to some extent the weakness that we've seen in Canada, South Africa, and Russia last year. US palladium mine supply was basically or largely unaffected by COVID. You also had the ramp up of the fill the mill project at the East Boulder mine in the US, which was fully ramped up at the end of last year, which further helped to boost palladium mine supply out of the US. Canadian mine supply, however, was down. You had mine closures and suspensions during the year, some for COVID, some because of maintenance work. But basically, it ended up resulting in Canadian mine supply for palladium declining during the year. This year, we forecast palladium mine supply to rise. Pretty much every major palladium mining region except Russia is expected to see a increase in output. In Russia, we think, or in Russia, because of the suspension of the two mines earlier this year, that is expected to weigh on palladium mine supply, but increases in other regions is expected to offset that. I'm sorry, we don't expect palladium mine supply to increase this year. Palladium mine supply is actually expected to decline to about 6.6 million ounces and fall about 1.5% from last year. It's total palladium supply, which we expect will increase during 2021, driven primarily by an increase in scrap supply, which we think will offset the weakness that we've seen in or are expecting to see in Russian palladium mine supply. So total palladium supply, we think, will reach 9.2 million ounces in 2021, which would be up about 2% from 2020 levels. So moving on then to palladium fabrication demand, COVID hurt pretty much every sector of palladium fabrication demand during 2020. It slipped to 8.5 million ounces during the year, which was down about 14% from 2019 levels. Passenger vehicle sales were the primary culprit here. You had a sharp contraction across markets during the first half of the year. There was a pickup in demand during the second half, but it was not sufficient to offset the weakness that we saw in the first half of the year. The auto sector was also hurt by a variety of other factors, like you had the shrinking of the gasoline auto engine in Europe, which was something that ended up weighing on palladium fabrication demand from the auto sector. There were a couple of factors that did help to support palladium demand from the auto sector, one of them being the ongoing purchase of large vehicles here in the US, which is something that is a positive for palladium fabrication demand for all PGM demand. And this year we forecast palladium demand from the auto sector to rise, driven primarily by an improvement in passenger vehicle sales, an ongoing purchase of large vehicles in the US. However, the shrinking of the gasoline engine market in Europe is something that we think would be a headwind. And another headwind we think is the shortage of chips, which is halting production at various facilities. So that's something that would again act as a headwind to palladium fabrication demand this year. Electronics is the second largest use of palladium. The source of demand declined in 2020, but not as much as the auto sector did. You had an initial pullback in demand because of suspension of production, and part of that is the reason for the problem in the chips supply that we're seeing today. And also another reason that weighed on electronics demand was the ongoing thrifting of the metal, given the high price of palladium. That said, there were positives that helped electronics demand, and that was primarily the increase in demand for electronics which were needed for work from home or school from home activities. So the increase in laptop sales was something that that helped to provide some buffer to that weakness in electronics demand last year. Total palladium demand, we forecast that to rise in 2020, driven primarily by the economic recovery, which we think will help demand essentially from all of the sectors. However, the shortage of chips, which is hampering auto production, we think that's something that would be a ongoing headwind during the current year. You also have the shrinking of gasoline market share in Europe, which we think will be a headwind for palladium demand. And the increased use of platinum in gasoline engine catalysts. That's another headwind that we think will affect palladium demand negatively this year. So the next few slides look at the various factors that are influencing palladium fab demand. So what you're looking at here is basically passenger vehicle sales in China and the US, two of the largest gasoline engine markets. Sales have been in a declining trend for the past few years. So far this year, sales have been stronger than what they were in the last year, but then again, we're comparing to an extremely weak period of demand. Passenger vehicle sales, we think, will continue to rise, but the chip shortage will sort of create a environment which will act as a headwind to the amount of sales that we see in the current year. This is a new development. So the decline in diesel passenger vehicle sales has been something that's been ongoing for several years now. And up until last year, at least a part of those sales was being diverted towards the gasoline engine market. But we saw that change last year where there's just, what we're looking at here, by the way, is market share of passenger vehicle sales by different fuel types and engine types in Europe. So last year you saw a shift away from both internal combustion engine markets towards alternative energy and alternative technology engines. So this is a new development and a new concern for the palladium market. And we think that this is something that would continue in the coming years, where there's a shift away from gasoline as well as diesel, especially in Europe, towards battery electrics or hybrids. And that is something that could will act as a headwind to palladium demand. This is the split of passenger vehicle sales or light duty vehicle sales in the US. And as the chart shows, light duty trucks have been accounting for an increasing market share in the US. As of the end of last year, they accounted for about 77% of market share, and that has continued at least through the first quarter of this year, the first half of this year. Increasing oil prices might hurt this trend, but we don't expect a major reversal just because there's a affinity almost for these larger vehicles within the US market, which we think is something that would be a positive for palladium. So while palladium supply declined sharply during 2020, palladium fab demand declined even more sharply, resulting in a surplus of about 484,000 ounces during 2020. That was a pretty large surplus, but there was sufficient investor interest in the metal that this surplus was absorbed. And we know that investors were interested because despite this surplus, you still had palladium prices at extremely high levels pretty much for most of last year, with the exception of the short period of time in March, April, when all asset prices had declined. I think there are many reasons for investor interest in palladium. The ability of palladium prices to sustain themselves at elevated levels and hit fresh records from time to time has definitely helped to increase investor confidence in the metal. Additionally, prior to 2020 and the forecast for deficits once again in this year, I think that is again something that helps to reinforce that investor confidence. And so you did see a surplus last year, but you did see a lot of investor interest in absorbing that surplus as well. ETF holdings, investors in these products have turned net buyers in 2021 after being net sellers for several years. But like Jeff mentioned earlier, this is just one very small portion of palladium investment demand. A lot of it is not visible easily in the open market, but there is clearly a lot of demand for palladium from investors, which is what is helping keep palladium prices higher, and which also explains that despite a large amount of inventory available in the market, the prices are still at record levels. So with that, we move on to rhodium. Total rhodium supply slipped to about 905,000 ounces in 2020, which was roughly a 12% decline from 2019 levels. You saw here both a decline in mine supply as well as secondary supply during the year. Now, nearly 80% of rhodium mine supply comes from South Africa. And as discussed before, the region experienced a pretty sharp decline in PGM supply during 2020. So this clearly had a major negative impact on rhodium total supply. Total rhodium supply, we think, will rise during 2021 with both mine supply as well as scrap supply rising during the year. But despite that increase, we still expect total supply to be lower than levels that they were at during 2019. And again, this is primarily tied to lost output out of Russia. Scrap supply, we think, will continue to benefit. You have rhodium-rich feedstock and you have high rhodium prices, both of which are factors that would be positive for rhodium scrap supply. There are certain technical issues related to extracting both rhodium as well as palladium from the autocatalyst substrate, which does tend to create bottlenecks. Some of that was relieved last year when the markets had slowed down. So that should be less of a concern in the current year. So moving on to rhodium fabrication demand. I'm sorry about this.
Rohit will resume as soon as that PA announcement is off behind him. Please stand by. While we're waiting for him to resume, I should say you can ask questions in writing by going down to the question part on the webinar bar and type in the questions. I'll ask you, try to be succinct and clear as to what your question is. Sometimes we get questions that we can't quite figure out what the question is. Let me hand it back to Rohit.
I'm sorry about that. So going back to rhodium fabrication demand. Rhodium fabrication demand was badly hit during 2020, primarily because of the weakness in the auto sector. As discussed before, weak passenger vehicle demand was one of the main reasons why you saw that weakness in the auto sector. And the glass sector, the glass manufacturing sector, that was another sector where you saw demand soften, and that primarily had to do with the high price of rhodium, as discussed in the platinum section. So rhodium fabrication demand in 2020 stood at 879,000 ounces, which was down about 17% from 2019 levels. This year, we forecast rhodium fabrication demand to rise to about 952,000 ounces, which is up about 8% from 2020 levels. We expect all sources of demand to show gains during 2021, except for the glass industry. So the rhodium market flipped to a surplus last year and is expected to remain in a surplus this year. But despite that, the prices have risen strongly, and that's primarily because these surpluses are small and follow 8 consecutive years of deficit. And in fact, if you go back to 2000, most of the years between 2000 and 2020 have been deficit years. So it's estimated, our estimates are that by the end of 2019, there was virtually no inventory available or easily available in the market, which explains that sharp run up in prices that we saw just prior to the pandemic, and the quick rebound that we also saw during the second half of 2020, as well as the first several months of 2021. So given the importance of rhodium in auto catalysts and the heavy reliance of rhodium mine supply on South Africa, results in any surplus metal being quickly absorbed, and inventory holders requiring essentially higher prices from fabricators, or higher prices in the market, so that for fabricators to be able to get access to the metal. We do think that the rhodium market will remain tight. We do think prices will cool off a little bit from where they were earlier this year. When prices have typically risen in the way that they have, it ends up resulting in a market where alternate substitutes are found to replace the use of rhodium. So the sharp increase that we've seen in rhodium prices will be negative for rhodium fabrication demand in the long term. Right now, it's an extremely important component of the PGM auto catalysts, primarily used to reduce NOx emissions, which are the main target of emission standards at the moment. So with that, I will pass this back to Jeff to speak about the minor PGMs.
Hello. Rohit, you have to pass me the screen. Okay. So hopefully we're back here. Thank you, Rohit. Very thorough, very intense. PGMs have always been a very interesting market because there are 3 of them major ones that we look at, and it's a tremendous amount of information because it's 3 metals instead of 1 with gold or silver, and also because there's an interplay. So you get to a point, for example, in 1990, when South African producers could give away their platinum because rhodium prices were high, and vice versa. So there's an interplay there that's very important. We've gone on for more than an hour now, so I'm just going to briefly go through the other 3 PGMs, ruthenium, iridium, and osmium. And what you see are, these are very small markets. They're very highly specialized metals. There hasn't been a lot of major uses because there isn't a lot of supply. You have seen some major uses come along in ruthenium and in iridium, in recent years, and that actually has caused these spike prices that you see from time to time. It's interesting that in ruthenium, and I'll show you iridium in a second, we saw the price rise sharply late 2017, early 2018. It plateaued. You had fabrication demand from a number of chemical uses and electronic uses, catalytic applications and things like that in various chemical process factories and some electronics. Then prices really shot up in the first half of this year. They went from $250 to about $800 in the market. And that, I think, reflects the fact that you have very tight supplies and very few above ground inventories perhaps left in that market. A very similar situation in iridium, but much more intense. Iridium is being used in the crucibles and other equipment that's used to make crystals used in LED lighting, and LED screens are becoming ever more ubiquitous. So you have a lot of demand for iridium for that application. You also have a little bit of demand for iridium in fuel cell applications and in some other electronic uses. Our view toward both iridium and ruthenium over the last several years has been that you're probably living on borrowed time. You've been drawing down the inventories of above ground refined metal built up in a long period of time when the amount of byproduct ruthenium and iridium is being refined, recovered from PGM ores. And you probably are really getting to the bottom of the barrel in those inventories, and that's being reflected in these rises in prices. The sixth metal is osmium. I have noticed some people trying to market osmium to investors. From a capital appreciation perspective, this chart says that it's probably not the greatest investment. There are other problems with it. And in fact, with all of these metals, we have always been very cautious in advising wealthy individual investors to buy small amounts and to sell it strategically. We had an investor back in the 80s who bought a tremendous amount of silver. It was a historically important and significant tranche of silver, and that turned him on to the precious metals bug. He came back and said that he wanted to buy some iridium and ruthenium because someone at some restaurant had told him that it was these were good investments. We told him all of the reasons why an investor should not buy large amounts of this metal. So he went to a major white shoe investment bank, and they bought it for him. And then when it came time to sell, because the price had risen, he couldn't get the price because the bid-ask spread in these markets that are very small, very illiquid, and don't have terminal markets was very large. So we tend to advise investors to avoid these metals, but they are very interesting. A few pieces of advertising, and then we'll open it up for questions. You can buy today's Platinum Group Metals Yearbook online. You can buy the gold and silver yearbooks that we released earlier in the year. They're all available at our website, cpmgroup.com, in the store. We did create earlier this year a retail investor program, which gives you the yearbooks as well as a sample of our monthly precious metals advisory, a monthly tear sheet, which has our 8 quarters of projections for platinum, palladium, rhodium, gold, and silver from the precious metals advisory, special market commentaries, special market alerts as we produce them, access to some of our other issues, and our trade recommendations for gold and silver sent directly to you. So the retail investment program is actually gotten off to a pretty good start, and we've had a lot of interest. It's a lower cost way to access CPM Group's research consulting services and our analysts. We also started open forum events. These are things that we did live at the old silver summits when they existed in Coeur d'Alene and then Spokane and then San Francisco. We had our first one last month. Our next one is August 25th. It's a Wednesday, 11 o'clock in the morning, I believe is the time that we shoot for it. It's about an hour. We don't have a formal presentation. We just open it up for questions so people can ask us the questions that they have at it. And retail investor clients and program clients, as well as our larger institutional and government and commercial clients, are all invited to join these things. So I'm going to, with that, open it up for questions, and Carlos Sanchez from our research group will be asking the questions that come in. Carlos, you there?
Okay, here, Jeff. Looks like we have a few questions. First question, will PGMs be mainly impacted by the water electrolysis boom?
Rohit, you want to take that, or should I? Okay.
I mean, I think, like I mentioned, the use of platinum in hydrogen and fuel cells is something that you're already seeing, and there's a lot of effort being made towards producing green hydrogen in a I guess they need to find ways to produce it cost effectively, and at least part of the cost problem has to do with the use of precious metals in these fuel cells. So I think though it might seem like it could be a big positive for platinum in the future, that maybe that is the hurdle that needs to be jumped, which is that they need to reduce the amount of these metals being used in fuel cells and electrolysis. So it may not have that much of a positive impact. That's what I would think.
I'm probably a little bit more skeptical. The alternative to platinum plated steel electrodes is titanium plated steel electrodes, and the cost differential is extremely high. I'm not sure that the increased productivity and efficiency and effectiveness of the electrodes by using platinum rather than titanium justify the shift. So I'm a little bit more skeptical about that. Next question.
Okay, next question. Do you expect a dramatic impact on PGMs by the ballast water systems?
By the what water systems?
The ballast water systems.
I don't understand what a dollop water system is. Do you, Rohit?
No, I'm not sure what the answer to that is.
Okay. We'll move on to the next question. Will rhodium see new price highs? And what is the price forecast for platinum and palladium?
Rohit, you want to do that, or shall I?
I could start, yeah. So we do think rhodium, we don't know if rhodium prices will necessarily see new highs. They already rose pretty strongly. There is potential for rhodium prices to retest those high levels. There is potential for it to get higher. It's an extremely small market. It's an extremely tight market. So you could potentially see an increase, but I think there's, at least in the short term, a likelihood for some further softness. Again, we don't expect necessarily that rhodium prices would decline sharply either in the near term, just because of the current market conditions and how tight the market is. So there's probably more potential in the short to medium term for firm to stronger prices versus weaker prices.
Okay, next question. With the high prices of PGMs, do you see any impact on recycling due to the high cost of financing?
The high cost, the high prices of PGMs obviously have a positive effect on recycling. The costs of financing those systems I'm sorry, I'm smiling because I think I know who asked this question. The financing costs are an issue, but ultimately we think that those issues will be resolved in a way that allows at least well-financed entities to finance the process of recycling primarily platinum, palladium, and rhodium from auto catalysts, but also PGMs from electronics and other things. I think that financial obstacles get resolved, not necessarily in the most efficient way for the recyclers and refiners and processors, but they ultimately get resolved.
Okay, next question. Do you see any ramifications for platinum supply based on the recent COVID and political developments in South Africa?
I'll let you take that one, Rohit. Well, maybe not. The ongoing COVID problems, and now you have the arrest of Jacob Zuma for contempt of court, and you've had some riots over the last couple of days there. There are any number of social, economic, political, and epidemiological problems in South Africa. Right now, they do not seem to be affecting production. We did see them affect production last year, but the mining industry was quick and effective, I thought, to respond and find ways to get back to work relatively soon. I suspect that they now have a better idea of how to operate should the COVID pandemic in South Africa continue to worsen.
Okay, and it looks like we have this last question. What is the ratio of substitution in catalytic converters for platinum for palladium? Is it 1-to-1? If so, will this be a big driver for platinum going forward?
The answer is yes. It's 1-to-1, and it will be a big driver for platinum and palladium demand in auto catalysts and in other catalytic applications going forward. If that's the last question, I will thank you all for bearing with us, and we'll talk to you soon, I hope. This completes the cycle of our annual yearbooks, gold, silver, and Platinum Group Metals Yearbooks. So we won't have another yearbook launch until early in the first quarter, well, in the first quarter of 2022. We do have these open forums that we'll be doing on a quarterly basis. So we'll have one in August. We're planning another one in November. And we're looking at other ways to be more video oriented going forward. And we're always available in writing. info@cpmgroup.com is the best email address to use if you have questions or issues or you want to talk to us about anything. Until next time, take care, and we'll see you soon.